Hi there, this is Matt Sinclair, and this is the MIP Capital Partners Core Plus Fund 2 Q2 2026 update. So I'll start with the conclusions. Um, Fund 2 has significantly outperformed our forecast on a T12, so that's trailing 12-month basis. And the big picture conclusion, the outperformance is really attributable to two main things. The first of which is a very, very favorable rate of collections. And the second thing is operating cost management. So collections have met or exceeded our forecast in 11 of 14 months during the stabilized period. And again, the stabilized period is the period beginning the month post permanent financing, which occurred in the spring of 2025. And so we have quite a bit of operating history now for Fund 2. And again, we're able to look at things on a trailing 12-month basis, which, given the lumpy nature of costs experienced in this business, is definitely the best way to accurately measure the efficacy of the economics of a fund like this. And so at 11 of 14 months exceeding our forecast in terms of collections is really significant, because at the end of the day, what matters is how much cash you're actually getting from your tenants. I think the collections is a heavily underutilized metric. It's very simple, but often overlooked. If you just look at the P&L of financial statements, whether you're in multifamily or single family, there's many things within the P&L that can obfuscate the true cash reality. And collections, I think, is just a very simple way to look at what did we think we were going to get from tenants and what did we actually get. Additionally, our NOI margins were exceptional, really because of cost management. And so on a trailing 12 basis, Fund 2 experienced an NOI margin of 80%. And critically, the NOI less CapEx as a percent of revenue is 76%. So that's exceptional, honestly. Much far above our forecast. And our forecast is, again, very granular and rooted in reasonable expectations, but we've really focused on cost controls. I think cost management is the best way to manage the current operating environment we're in. One thing I wanted to point out right up front here, just for purposes of transparency, and again, we've previously communicated this report to investors, as 1-year leases expired. So when we initially leased up houses in 2025, it was predominantly 1-year leases. That was market norm at that point. Once those leases expired earlier this year, we did experience a dip in occupancy. Now, occupancy is currently 100%. I'm recording this video on August the 13th. And as of right now, Fund 2 occupancy is 100%. We did experience a dip in occupancy, and I'll dig into the details just in a few minutes here on a subsequent slide. But 96% is the weighted average calculated by days and months occupancy since the beginning of the stabilized period. So we are still tracking above the forecast of 95% occupied in a steady state. And I think critically, the new leases that we've executed in 2026 have been 2 years in length, which that should really help us preserve occupancy through 2027. A couple other things I think that we've had this Fund 2 operating for a long enough time to really start to be able to look at this in comparison to some of our publicly traded peers and really benchmark our performance. And so expectations are very, very high. I created this to compete with the best in the world, and as of now, we absolutely are. So on a trailing 12 basis, Fund 2 has experienced a turnover rate of exactly 25%. So that's in line with Class A SFR REITs. Now, Fund 2 is only a 20 house fund, and it has been around a while now, but not long enough to have like a statistically valid sample size such to draw a proper inference from. But as time goes on, we'll be able to validate these claims. But I would say 25% turnover is decent. We're looking to improve that. The 2-year leases will definitely assist in hopefully lowering that rate. So when we're having this conversation next year, I'm hoping that 25% turnover rate is a bit lower. Critically, on a T12 basis, Fund 2 experienced a cost to maintain each house. And in a subsequent slide, I dig into the specifics of how that's actually calculated. But this is a critical metric, and again, often overlooked. But we have the financial systems to actually record this on a house-by-house basis, and something I track very closely. A major underpinning of our thesis and why we are purely new construction is with the run-up in inflationary pressures and the cost of building materials and labor. Our supposition was that focusing on purely new construction would really help us weather potential additional increases in cost of building materials and labor. And you can see this on the right side of the page. And just the text might be a little bit dense, but our cost to maintain each house on a trailing 12 basis, so that is an annual metric, was about $1,500 versus just under $4,000 for Invitation Homes. They were basically $3,900 for Invitation Homes, even though the average in-place rent is approximately comparable. So they're comparable from a rent perspective, just a level set. But if I do the quick math on that, that's about a 60% reduction, 61% versus what Invitation Homes experienced on a trailing 12 basis versus what we did in terms of the cost to maintain. So that's enormous over time across the portfolio. And that, again, is, I think, a testament to the business model. And additionally, we have great property managers who are doing a very, very good job of turning things efficiently. Cost management's a major focus for us, and I'm also personally involved in reviewing every budget. Couple quick points on this slide. Like I said, the Fund 2 portfolio is currently 100% occupied. As a result of very favorable lease-up velocities back in 2025, we were able to lease up much faster than anticipated, and basically were able to initiate distributions a month early, such that our distributions to our investors versus our forecast are 8% above the forecast. So that's great. We're really happy to be able to deliver, and we are also large LPs ourselves, and so that's our main focus, is delivering value for our investors. Another key point here that I want to touch upon is the average realized rent to tenant income. So that's 23%. So even though we are Class A, we are certainly within the 90th percentile of rents in the submarkets. Our tenants earn quite a bit of income relative to rents, and so the ratio is realized rent to tenant income. We want this number to be low, such that rents are affordable. It's just sort of less risky. This is a very, very favorable statistic. So 23% average realized rent to tenant income is unusual. If you're looking at Class A housing, it tends to be in the mid-20s and even high 20s, depends on the geography and jurisdiction that you're in. If you're looking at workforce multifamily, it can easily be high 20s and into the 30s. The reason that can be an issue is that you will likely have more delinquency. You certainly have more late payments, and then more risk of bad debt, which then ultimately will necessitate some form of collections and potentially eviction. With our high income tenants, they are able to weather any type of adversity quite well, and it is much easier to raise rents with someone who has capacity and ability to pay. Now, if the tenants have higher incomes, it begs the question, why don't they simply buy their own homes? Why do they need to rent? Well, it is true, and I personally review a lot of the applications we get. I went through every single tenant package that we have in Fund 2, for example. Most of these tenants would not qualify for conventional mortgages, and that's absolutely the case, and increasingly so given the increase in interest rates. So although these individuals earn quite a bit of income, it would be difficult for a lot, if not most, of them to actually qualify for a mortgage. And so they take very good care of their homes. Most of our tenants act like owners, and we maintain the properties such that, that's the expectation, that they treat the homes as if they're owners. But there is a stickiness to their tenancy. So this page, and again, as I alluded to earlier, collections I think is just of paramount importance. It's a very simple metric, but often not tracked. But I'll start at the top of this slide. So as 1 year leases expired in March through May of 2026, we did experience a dip in occupancy. And so, for the sake of full transparency, we are showing this, and we will always be completely forthright in everything to do with all of our funds and our businesses, just for the benefit of LPs. Really, the rationale here, though, is just 1 year leases rolled off. With the new lease ups for the tenants that did turn over, and then we got new tenants, the new leases are 2 years in duration. And so that will, knock on wood, keep occupancy elevated, and we'll try to avoid a dip in occupancy like we did within the spring of 2026 here. But overall, still, as I alluded to earlier, we are tracking for the stabilized period from May of 2025 onwards. Our occupancy on a weighted average basis is 96%, and so we are above forecast overall, and our key now is to just cut the volatility of this. As you can see on this slide, it shows a June figure of 97% occupied. I am purposely calculating each of these actual occupancy figures as a weighted average by day per month. That just gives a more accurate depiction, and that way we can pick up month fractions. Like if a person moves in on the 14th of a month, we'll be able to properly allocate days accordingly and make sure that shows up in these statistics. As of August 13th, when I'm recording this video, like as I said earlier, we are 100% occupied and tracking quite well. The bottom of this slide shows this collections topic I discussed, and we have met or exceeded our forecast in 11 of 14 months during the stabilized period. And again, this is really important because that's the actual amount of cash you're getting from tenants. So getting into some of the details here, this is a variance analysis and something that I track on a monthly basis. And I think it's of paramount importance to really be as granular as possible in our underwriting at the outset, and then in the ongoing performance management. And that this allows us to take actions if necessary to proactively address problems before the problems become big problems. And so, laying things out in this way lets us know where our dollars are going, and that's the best way that we can really manage people's money most effectively. A couple things I'd like to point out on this slide. So, number one here, you can see there's a little number one, base potential rent. And so you can see that there's a negative variance of 2%. So in order to facilitate lease ups, we did lower rent on a couple of houses, and that facilitated faster lease ups, which ultimately led to more cash flow. And so there's always a series of calculations that are made on how much you set rent at, and then when you're leasing up houses, to what extent you do lower to induce demand, because it's a trade-off. If you go longer without having a home occupied, there's an opportunity cost, you're losing dollars. But if you have rent too low, then you're losing dollars on a go-forward basis on every dollar you would have had from higher rents. And so it's really a case-by-case basis. And we manage each house as if it's its own business, and it is very much a bespoke set of decisions and calculations for each house within the portfolio. But as you can see, overall, our revenue was 3% higher than we forecasted, and that's because there's more to revenue than just rent. There's several other types of fees that are in there. Our vacancy was basically approximately in line with the forecast. And again, overall, from a revenue perspective, compared to most of our peers, this is very favorable. Being up 3% versus the forecast is quite a good outcome. And I'll get into the cost items. Very important here, we're reviewing this on a trailing 12-month basis, because in this business, many expense items are lumpy. And so if you were to just look at this business on a 1 month or even quarterly basis, you might draw an invalid conclusion just because certain expense items weren't going to hit in that period, and then you might not be prepared for a subsequent period. We make sure that the way that we model each house is as if it's its own business. It has its own forecasted P&L for year one, and then that gets rolled up into a bigger model in terms of the lease up schedule by tranche, and then is pushed forward on a go forward basis. And again, that shakes out to a forecasted overall NOI margin, and it's broken down by line items to arrive at that NOI margin. But on this basis, overall, we significantly exceeded our forecast from a net operating income perspective, and that's pure cash to the bottom line. So that's ultimately what matters. And the big item here is just maintenance and turn expenses. So all new construction homes eventually won't be new construction homes. So I don't want to completely give ourselves the benefit of new construction indefinitely, because then when you have to pick an arbitrary time in the forecast period where a house ceases to be new construction. And so instead of doing that, I'm just basically assuming that we're going to have expenses, and then in this case, we incurred expenses that were substantially less. So our maintenance and turn expenses came in a lot lower. Part of that is we just did a very good job of managing expenses. And another part of that is that a lot of the expenses associated with turns are capitalized instead of expense. So the number 2 item, as depicted on this slide, 5 of 20 houses experienced turnover, but the majority of the turn costs were capitalized versus expense. So on a subsequent slide, I'll discuss that. But overall, OpEx was substantially below expectations, and that's, again, a function of conservative underwriting and then also the benefits of ongoing cost control measures. That 80% now on an NOI margin, though, on a T12 basis, that puts us up there with anyone in the industry. It's quite a bit better than the single-family REITs, and we're very proud of this, and we're going to try to do even better. So on this next slide, big picture here, in a lot of real estate investment funds, they won't show CapEx. They'll show NOI and it looks great, but CapEx will be obfuscated, and CapEx items will be buried in the income statement in some capital improvement line item, and it can be very difficult to actually dissect the specific cash costs to keep a house operational in a given year. And ultimately, it's cash flow that we care about. And so CapEx is enormous, especially given the run-up in building material and labor costs. So we break CapEx down into 2 broad buckets, the first of which is repair and maintenance CapEx, the second which is turn CapEx. So repair and maintenance, let's say that there's a roof that needs to be fixed, that would fall into this category. Turn CapEx is experienced when a house turns over, a tenant leaves, you need to get a new tenant in place, and then there's oftentimes some repainting and touch-ups, potentially some new carpeting that needs to be redone, a bit of landscaping and so on to make the house just very attractive to a new tenant. We did very well from this perspective. And again, we did experience some turnover, but overall, it's quite good, especially if you think about this in a cost to maintain each house. So overall, the cost to maintain each house is about 10% below what we forecasted. And again, that's very favorable, but it's substantially below what it would have been if these weren't new construction houses. And then finally, breaking this down to EBITDA, which again is an income statement item. So we are very, very efficient with our operations, such that a lot of net operating income, like the vast majority of net operating income, falls to the bottom of the income statement, and as EBITDA being is a proxy for cash flow. And again, it doesn't take CapEx into account, but it's something that we need to think about from a corporate evaluation perspective. And looking at this on a trailing 12-month basis, having a fund level EBITDA of 65% is exceptional. We're very happy with that. That's quite a bit above the forecast. And again, that's where we're very, very cognizant of cost management, and we maintain minimal overhead. So thank you very much for taking the time to listen to this. The next report for Fund 2 will be based on end of September 2026 result to cover the period, the trailing 12-month period ending Q3 2026. Thank you very much.